We are joined by Adrian Foster, who's Asia Head of Financial Market Research at Rabobank. Thanks so much for joining us, Adrian. So what is your reaction of the stress test results? Are you encouraged, or were they just too soft?
I think, of course, any information is better than none, so in that sense there's a small positive here. I agree with the assessment that these stress tests haven't been the most stressful that one could imagine, but I think it's worth remembering banks by definition are creatures of leverage. You could always come up with a stress test that would show a bank has real problems or a banking sector has real problems as a result of the leverage across the banking system. So in that sense, that's not the challenge. You know, under what scenario would they fail? So you have to come up with a reasonable set of scenarios. I think the scenario that the Europeans have used, the downside risk, the 3% away from GDP forecast, that's a much more bearish assessment of the Eurozone economy than we ourselves have for this year and for next year. So I think in that sense we're going to muddle through here.
What about the sovereign debt issue? What about the sovereign debt issue? Because they only tested the trading book rather than the bank book.
That's right. If there were a default amongst some of these Club Med countries, I think it would have bigger implications than this assessment has uncovered. Keep in mind, though, the European Commission, the individual governments and the IMF, they've already put in place this €750 billion support package. So I think that's relevant to this debate.
So was this stress test really not very necessary then? I mean, if the money's already been raised? For example, the stress test just found that only $4.5 billion of capital needs to be raised. That's about a tenth of what the analysts had been expecting. Were they just being too pessimistic?
I don't know on that. I guess if you put a more stressful stress test, you would come up with some bigger numbers. Maybe that was underpinning some of these assessments. But you're right. There's been several €100 billion raised over the last year or so. I think Europe's a little bit unlucky in a sense that the US stress test coincided or was alongside the start of global recovery. The Europeans are coming at it a year later, so in that sense they're not going to get the uplift from the recovery and the positive implications for the broader market there. I think over time this is only going to be put to bed when we've got budget deficits around the 3 to 4% of GDP in these Club Med countries from, of course, the 8 to 9, 10, 12% that we currently see out there. That's going to be when I think people have ultimate confidence that we're through this, and that's going to take, I think, 3 or 4 years.